And I think, the markets are looking for a real sign that the Fed is serious about inflation, but not so deadly serious that they're unwilling to contemplate some of the things they've said in the past, like that inflation could cool, and they're really going to be data dependent going forward.
Okay. So, Mark, let's get to what you're saying, actually. You believe a lot of the volatility we're seeing in the markets due to overreaction of Fed policy. As you just mentioned, or we just talked about, two-day meeting today, 50 basis point hike expected with the goal of combating inflation. You also believe that inflation is going to moderate in the second half of the year. And is that because of these rate hikes? The potential one that we're seeing tomorrow, 50 basis points largely expected and possibly 75 points. Is the Fed actually going to achieve its goal of tamping down inflation?
Well, look, reaction, overreaction. I think, in a typical recession, you can see the market sell off 30%. We've done 13, 14% in the S&P 500. And that's kind of the market saying the way the Fed is talking, maybe it's close to 50-50 that we get a recession in the next 6 months. And I think for us, we think the odds of a recession in the next 6 months are lower than 50-50. So we think that the market can go higher. And our view is anchored in what you've said, which is that when you look at the supply constraints around COVID, when you look at the impact of lower liquidity and the Fed jawboning, we think some of that inflation is going to come out of the market. So we're going to see moderating inflation and moderating growth into this year. And that will give the Fed a little more flexibility in how they raise rates to combat what is certainly an inflationary and above trend growth environment.
So, Mark, I want to hit on something. You said you see it less than 50-50 of a recession. You actually have a bull case price target for the S&P of 5,100. That's about 1,000 points higher than current levels. I'm going to call this your base case. You don't use these exact words, but you have a base case of 4,700, about a 13% upside, where you see the Fed raising rates, energy prices rise as Russia stops supplying gas to Europe. Russia actually moves nuclear weapons close to the Ukraine border. China cases of COVID ease. That's just a lot of stuff going on. Do you believe all the potential downside from several of those things, do you believe those are already priced in and the market's just going to go up despite those things happening?
Well, we also have a downside case as well, which is 3,600, right? So we're trying to put a framework around all the things that could happen. But to get to the base case, what you need to have happen is to see the inflation come down a bit, and then for markets to reprice, not around a 3% terminal rate for the 10-year, but closer to a 2.5% 10-year. So it's certainly still a possible outcome for the year, and with a little bit of luck, yeah, we could go higher. Certainly the news out today is around death, destruction, pestilence, and war.
All right, Mark, stay with me just for a moment. The annual Milken Conference continues today in Los Angeles, where some of the world's leading investors, CEOs, and policymakers, they're gathering to share their latest big and innovative ideas. Our Brian Sullivan spoke with some of them about where they're positioning their money in this uncertain market.